All right, what is happening, everyone? Welcome back to another Dividend Happy Hour. What a day. What a freaking day. What a week overall. Crazy, crazy week on the stock market. I think we're all probably sitting at all-time highs right now, which, I guess is cause for celebration, right? Let me show you guys where we're at in the portfolio real quick. So let's jump over here to the spreadsheet. This is where we finished up the week. Look at this, guys. $109,980. There was a brief moment, like midday, where I did see it get up as high as like 110.3. So, yeah, didn't quite finish above the $110,000 mark, but we are just like right there. Still pretty cool. It was really only like a month ago, right? Maybe just about a month ago now that we hit 100K in the portfolio. And now we're already 10% of the way to the next 100K, which I think we talked about this last week. We talk about it all the time. On one hand, is pretty cool. It's pretty cool to see, these substantial jumps in the portfolio value. But then again, man, and today's a great example. It just feels like the gains have been coming way too easy lately. And that definitely makes me concerned. And it looks like I'm not the only one. Like Xander here says, yeah, and I saw a message from you right before I started the stream. Yeah, it's got me a little bit worried. We'll see what happens though. We'll see what happens. Even if there does, even if we do see a pullback from here, at least hopefully there will be some good buying opportunities. Because I do feel like lately it's been kind of slim pickings. There's a few stocks that look pretty good right now, but yeah, not too many interesting discounts out there in my opinion. But enough rambling, guys. Why don't we kick this thing off the best way we know how? Grab whatever it is you're sipping on. And guys, I got something special tonight. Got a little something special tonight for the first time in a while. Having a little brewski on the live stream. So grab whatever it is you're sipping on. Cheers. Here's to you guys. Thank you so much for tuning in to another happy hour with me. I'm so stoked to be here with you, and I appreciate your time. And also, here's to the dividends. Here's to the pursuit of that sweet, sweet cash flow, because that's really what's bringing us together at the end of the day. And also, here's to all-time highs. Congratulations to all of you guys out there who are seeing some gains in the portfolio. It's a good feeling. Like we said, it's bittersweet, but still feels good. So cheers, guys. Let me know a few things. I'll show you what I'm sipping on here in a sec. But I want to hear a couple things from you guys in the live chat or in the comments below if you're watching the replay. Number one, I would like to know, what did you buy this week? Which stocks did you add to your portfolio? Number two, what are you sipping on? Looks like, who said it? Xander's there drinking some water. But what are all of you guys sipping on out there? That's number two. Number three, did anything cool? I mean, I know we're at all-time highs, but did anything else cool happen in your guys' portfolio? And number four, do we have any first-timers here in the stream? In case we do, in case this is your first time tuning into the live stream, welcome aboard. We typically do this every Friday night, starting like right now, 5 p.m. Pacific time, 8 p.m. Eastern time, and it's always a good time. So let me know, or let us know. Okay. Oh, and real quick, here's what I'm sipping on. I'll just show you guys the label here. Here we go. Little Founders Brewery. And I don't know where they're from. Wonder if it'll say on here. Maybe you guys know. Oh, okay. Grand Rapids, Michigan. I've really been liking their beers lately. This is just like a Scotch style ale. But yeah, I've been liking their stuff. And it just sounded good tonight. So let's see here. Let's go through your guys' home advantage, noticing the watch. Yes, this is my only nice watch that I have. I've had this watch for a couple years now, for a few years now. So I don't bust it out too often, but I've been wearing it more lately. Okay, let's see. Oh, and by the way, guys, I did not actually buy anything this week. I bought SHD and VOO, but nothing else. Just that. Just the weekly dollar cost averaging. And also, on that note, I'm still sitting on some cash. I think I showed this to you guys last week. Excuse me. But at this point in time, I'm sitting on about $1,500 in cash. And I think it's a little bit more because I just got a Williams-Sonoma dividend today. So I think that was another 23 bucks. So we can add it to that number there. But anyway, let's see. What do we got here? What do we got? Darren, milestone this week. Finally decided to look at all of my portfolios, and I'm over 100K. Nice. Very nice. Congratulations. With my crypto, I'm at 145K. That's awesome. Congratulations. That's huge. Marcus is sipping on a Dos Equis. Very nice. Very nice. Vasco did not buy anything either. Trying to save some cash, sipping some water. There we go. Janice, all-time highs at 562K. Once this doubles, I am retiring. You know, it's crazy to think. So if you can maintain an average growth rate of just 10% over these next 7 years, you will double that number. If you can grow it by 7% over the next 10 years, you will double that number. That's pretty crazy. 7 years, really, if you can do 10%, which we'll see what happens. But if you can do 10% over the next 7 years, you'll be sitting pretty. Let's see. Benji says, what do you think? I'm close to 6K I'm 23 years old, started like 2 years ago, plus 20K in savings. My friend, I think that's incredible. In total, $26,000 at 23 years old, including your savings there. That's awesome. That's great. Jose says, drinking water only until I hit $100,000. There you go. There you go. Brandon, welcome aboard. First time on during a live, been watching your vids for a couple months. Thank you, man. I really appreciate this. Love the Snapstock app. Nice. Well, that's awesome. Thank you so much for checking out Snapstock. I'm really happy to hear that you're enjoying it. And if you have any feature suggestions or any suggestions for us, we're all ears. So that's really awesome. Bought Accenture, which is looking interesting. Zoetis, love that. Procter & Gamble, and some UPS. Ooh, UPS. Man, that one, I want to like it more than I do, but that one's got me scared. Got me scared. Chris here says, bought some VOO, Alphabet, Chevron, CDNS. Which one is that? CDNS. Cadence Design Systems. I have never heard of this before. Not a dividend payer, but a very solid grower. I'll show you guys what I'm looking at here. So this is Snapstock. And you guys can check this out if you want. There's a link to it in the description of the video. So Cadence up 30% over the last year. Very solid grower. Looks like pretty high valuation metrics, really high PE, really high price free cash flow, very low free cash flow yield, but still a very growthy company, which is interesting. It looks like the 5-year EPS CAGR is not that high, but it's basically just going from here to here. So, but the 10-year chart looks really good. Free cash flow growth has been nice. Revenue growth has been nice. Very, very high margins, almost 100%. Yeah. Wow. No debt. That's great. Yeah. Yeah, there's some good stuff. Good stuff in here. What do they do? If we go over to, okay, no surprise, they're in the tech sector, software application. Maybe if we just go to their website, it'll paint a better picture. AI supercomputer to transform silicone systems and drug detection. Okay, I don't know. I'd have to spend some more time with this one. To me, it seems a bit over my head. But what was that? 30 seconds of looking at it. Okay, yeah, man, drinking some Johnny Black. No buys this week. Yeah, there you go. Shamizzle. Shamir, good to see you, man. I feel like we haven't seen you for a while. It's good to see you in the stream. Kept buying VOO this week and sipping on some Diet Coca-Cola. Nice, nice. Striper Kid bought a new fund in my wife's portfolio. TSP, TS, goodness gracious, FSPTX. It's a Fidelity Tech Fund. There you go. Nice. Look at this, guys. Ken made it to $200,000. Unreal. Getting close to $1,000 in monthly dividends. Man, so you must have a decently high yield. Yeah, you must have a decently high yield. So let me look at some quick numbers. So let's say that you're getting, let's just call it 1,000, okay? That's $12,000 a year divided by 200,000. So I guess that's not too bad. About a 6% dividend yield in the portfolio. It's not too bad. That's decently tame. Emilio bought some more VOO in Main Street. There we go. Div went hard on SCHD. My goodness. Oh, and guys, I'm sorry. I keep forgetting to mention this. I should have done it right at the start of the stream, but it slipped my mind. We're probably going to end the stream around 5:45, 5:50. So we're probably just going to go for another probably 40 minutes or so. The wife's cooking dinner. She's got something good on deck, and I think it's going to be done around then. So I'm gonna cut the stream probably about 10 minutes early. I'm sorry, I should have mentioned that right when we started, but I totally forgot. So, Sir Dude Bro Man in the building. What's up, man? Okay, let me scroll down. Continue scrolling down in the chat. I'm about 5 minutes behind. And by the way, guys, if you have any stocks you want to look up, if you have any investing questions, just drop them in the chat, and we'll go through them once we get caught up here. So, yeah, good to see all of you guys. Seeing some familiar names. Good to see everyone. There we go. This is crazy. Dalen said with today's jump, I hit 54K invested in 19 years old. Man, that's seriously impressive. Good job. Yeah, that's a good question. So how fast are you doubling those dividends? I don't really know. I mean, okay, so here are my dividend stats right now. I don't know exactly how fast it's going to double. If it's just based on the growth rate, then it should double between 7 and 8 years if we're just looking at this dividend growth rate right here. But this doesn't take into account contributions either, or reinvestment. So it'll go a little bit faster. I bet we're realistically doubling dividends, I don't know, every 5 years or so. Maybe every 5 to 6 years. So, but that's still pretty good. That's still pretty good. Okay, let's keep going. Let's see. Logan sipping on a PBR. There you go. Portfolio almost at 50K. Nice. Jose almost at that 100K mark. Man, we have another week like this one next week. You'll be right there. Let's see. Nice buys here. Broadcom, Lockheed, Cisco, and VYMI. Yeah, this is a good question from Midway. So you don't auto reinvest dividends. Do you save the cash and look for good deals? I played with both ideas, but wondered what your preference is. Yeah, this is a good question. So I haven't dripped my dividends or automatically reinvested my dividends for quite some time. I think it's been maybe 3 or 4 years at this point that I've just been collecting the cash and redistributing it elsewhere. And it's been pretty good. The reason that I decided to do that was because I don't know. I just felt like I think I turned the drip off when I was maybe starting to get about $100 a month or so in dividends. And I just felt like at that point I could, because that $100 is about what I was contributing every week. So I figured that's like an extra week of contributions that I can choose to put elsewhere if I want to. So I thought that would really pack a punch if I just took it in cash and put it elsewhere. And yeah, it's been good so far. But I'll tell you what, like part of me has thought about, I don't know if I'll actually do it. I realistically probably will not, but I have kind of thrown around the idea of just turning the drip back on. And I think the big reason that I'm maybe thinking about doing it is just to, I think I'm looking at my portfolio and there's quite a handful of positions that I think are good, like great companies, but they've just gone so far above my cost basis in my average cost per share that I just have such a hard time adding to them. And this is just one of those big psychological hurdles that all investors suffer from. You just get anchored to your average cost, and it becomes hard to buy when it's above that. I mean, case in point, AbbVie is a great example. Lowe's is a really good example. Main Street's a good example. Snap-on's a great example. Williams-Sonoma is a shining example for sure. Excuse me. And I think these are all great companies. And I would love to own more of them, but realistically, I'm not going to pull the trigger on it myself. I mean, I could bite the bullet and do it, but it would be much easier done if I just turn the dividend reinvestments back on. And then as they, continue to grow and be good companies, I can simultaneously continue building my positions in them over time. So that's kind of one thought that I've been having recently. I don't know that that's trumps the thought of just wanting to manually redistribute that cash, because now, I mean, as we see over here, we're nearing $300 per month. I mean, just in the taxable account, let's look at that. It's about $250 because the dividends in the Roth IRA, which is coming in at almost $50 per month, that just gets put back into SCHD and VOO. That's easy. But yeah, this is still, that's a good chunk of change that I could, really do some damage with if I allocated it the right way. So, yeah, I'll probably just stick to what I'm doing, but, kind of throwing around the idea of switching it up. We'll see. So let's keep going. Yeah, Benji, I added some UNH and Cisco. What do you think? Yeah, I mean, let me look at Cisco actually. Let's go over here. I don't feel like I've looked at Cisco for a while. UNH obviously is pretty discounted right now. So I think you're probably buying it at a decent time. I don't really know too much about insurance companies. I mean, health insurance is definitely something that everyone needs here in the States. But as far as like analyzing insurance companies, it's like looking at French to me. So I just don't quite get it. But Cisco, so first and foremost, let's just start here. 7 red flags. Snap score is not great. I mean, the growth is not good. Everything else looks pretty decent. But let's just take a look. So growth, it's been slow. I mean, top line's the only thing that's really growing. Looks like earnings per share and free cash flow per share have definitely stagnated or have even declined. According to the 5-year CAGRs, they've declined. So that's not great. It looks like the margins are declining as well, which makes sense if the earnings per share is declining and the free cash flow per share is declining and the revenue's more or less staying the same. It makes sense that we would see these margins decline here. So I don't think that's a great sign. Debt doesn't look to be, too big of an issue. They did see a big increase in debt last year. But still it looks pretty well covered by the free cash flow. The net debt to free cash flow is only 2.25. So that's okay. The interest coverage is still high. You're not getting much dividend growth. I mean, these dividend stats too are pretty poor. Like a 2.4% yield is not bad. But if it was me, I would want to see a dividend growth rate that's much higher than this right here. So you're getting a dividend growth rate that's only slightly higher than the dividend yield. And I don't know, that just doesn't seem that interesting to me. So decent returns on invested capital. I mean, still double digits. It's not bad. So I don't know. I look at Cisco and I just don't see, I guess I just don't really see the draw, personally speaking. Xander, I would love for you to review my portfolio. How would I send it to you? So actually, coincidentally, my next video coming out is going to be my monthly portfolio review video. If you watch any of those videos, in the description of those videos, I have a link to a portfolio review submission form that you can fill out, and that basically puts you on a list to be featured in those long form videos. But also, I'm sure a lot of you guys have seen these over the last month. I started doing these short videos, these like 60-second clips reviewing portfolios from Blossom, which there's a link to that in the description of this video. So that's another option too. If you want me to review your Blossom portfolio, just create an account on Blossom. Once again, there's a link in the description, and just shoot me a message on Blossom or just tag me in a post, and I will add you to my list of portfolios to review from there too. So those are the only two ways. Can you glance at AMAT? Yeah, we can take a look at that. I feel like we looked at this one. No, maybe not. Yeah, we'll take a look at it right now, Tony. So jump over here. And okay, looking good so far. So decent free cash flow yield, actually. But it still looks lower. The valuation metrics do not look favorable compared to the 5-year averages. But seen a nice pullback in share price over the last year. No red flags. Really, really solid snap score right here. Very nice. Wow, perfect score in the dividends and buyback section. That's exciting. Okay. So, yeah, that's looking good. Double-digit growth rates from top to bottom. Really nice. Margins are actually expanding over time. So 10 years ago, the gross margin was 40%. Nowadays, it's about 48%, so it's almost doubled. It looks like we've added about 10% to the net margins as well, maybe more than 10%. That's a great sign. Free cash flow margins have stayed steady for the most part. Big jump in these last couple of years. We'll see where it goes from there, but this looks really good. Negative net debt. That's great. Yeah, I mean, this is looking fantastic, actually. It looks like the only potential blemish, I don't even consider it a blemish, but I know some people would, is the starting dividend yield. It's just under 1%. With that, you are getting a really nice dividend growth rate, though, about 15%, looking at both the 5 and 10-year averages. And not only that, this one looks to be a dividend growth rocket. And when I say rocket, I mean that it is accelerating over time. This dividend growth is actually getting better over time. So you don't come across that too often. And I should make note of that because that's really cool. Definitely doing a great job of buying back shares. Dividends very well covered, very high returns on invested capital, averaging almost 30% over the last 5 years. So yeah, this looks like a great business from top to bottom. They must have put out some poor earnings or something, huh? Yeah. They're about midway. No, maybe a little bit closer to the 52-week low, but not by much. So yeah, I think this is looking like a pretty good company just looking at the charts there. I like it. Oh, yes, Sam wants to look at Comfort Systems. We can definitely do that. From what I remember, that's a pretty solid looking company as well. So yeah, okay, let's go back over. I should just stay on the screen. Oh my gosh, Christian. What's up, Monsieur? It's so funny you're watching this. Okay, so and Christian is one of my best friends, guys, one of my good buddies. Monsieur. Okay. So Comfort Systems also looking pretty good. Definitely not at a great discount. I mean, it's up over 100% in the last year, which is crazy. Look at the spread. Look at the spread from the low to the high. Actually, we can just look right here. As recent as April 4th, it was $296, just under 300. Now it's at almost 700. That's just crazy. Okay, and I forgot to look at the breakdown, sorry. So perfect growth, and everything else is looking good besides the profits. But what does this business even do, actually? Okay, engineering and construction, so yeah, okay, so based on what they do, it's not really a surprise to see them have low margins. Okay. Yeah. Okay, so let's scroll down. Yeah, very growthy, no surprise there. Look at how fast the earnings per share and the free cash flow. I mean, all of them. Look how fast they're growing. Yeah, it looks like margins are expanding over time as well. So the bottom line's growing faster than the top line. That's fantastic. And we saw that here too, right? I mean, this earnings CAGR and free cash flow CAGR are a bit higher than the revenue. So No surprise there. Negative net debt in the most recent year. That's great. Very high interest coverage. Very, very low starting yield. So that's just like another one of those. But look at the 5-year dividend growth rate, about 30%. And this is another one of those dividend growth rockets, guys. Okay, that's 2 out of 3. I need to make some notes here real quick because this would be a good video. Let me jot this down. Bear with me. So we have Comfort Systems, we have AMAT. Yeah. Dividend looks to be really well covered. 10% payout ratio there, 12% there. Growing returns on invested capital. So the last few years have been really good. So this is another good looking one, but not good valuation. I'd have a hard time buying it right now. Yeah, Fast Eddie, this is a good question. You have an IRA, Roth, and brokerage account. So I just have a brokerage account, taxable account. I just have a taxable account and I have a Roth IRA. I do not have a traditional IRA. So just those two. And yeah, my Roth IRA is just SCHD and VOO, and I dollar cost average into those every week. And then the taxable account is the one that's only, individual stocks. So all hand selected there. Do you have a moon bag speculation portfolio for fun? No, it took me a second I had to think about that for a brief second to even know what that meant. So no moon bag speculation portfolio. It's just the taxable and the Roth IRA. So, did you hear my response on this by chance? I don't know how long ago. This comment was from 8 minutes ago. I don't remember how long I mentioned it, but I did go through the whole spiel there. Let me know if you missed that. And it looks like we have a little super chat here from that guy. Thank you, my friend, for the little one coming in the fall. Congratulations, bro. Dang, that's awesome. I've caught every dividend happy hour one way or another. That is really cool. So, we're 146 live streams deep, and I should go back and look to see when the first one was, but I think it was around this time, maybe August or so of 2022. No, because we had just moved to Vegas in 2022. So I bet it was maybe August 2021, like July or August or September 2021. So what's crazy then? We've been doing this live stream now for almost 4 years. I think that's it. Let me go look. Maybe it was 2022, but we've been living in Vegas now for coming up on 3 years. So sorry, I'm just looking in the chat. Okay, Xander, you did see my message. Okay, cool. Okay, where was I in the chat? Sorry, guys. Now I'm trying to do 2 things at one time. I just don't want to lose my place. Okay. So let's go to the live stream. I'll show you guys this. Okay, so let's go over here. So let's go by oldest. Dang, look at that. Look at this, guys. That's crazy. Look at that guy. So this was our last apartment in Sacramento. So, okay, actually, so first live stream was May 18th, 2022, which would have been, well, I guess, about three years and a few months ago. This would have been just a few months before we moved to Vegas. Yeah. What are we talking about here? Oh, well, we don't have to go through that. Cool to look at, though. Okay, back to it, guys. Matt wants to know, if I dollar cost average every month, is there any point in me building a cash position on the side in the case of large market drops, or should I just go all in? What are your thoughts? I think you could go either way. I think if you are just Okay. Where do I even start with this? I do think you could go either way, but ultimately, I think the whole point of dollar cost averaging and basing your strategy around that is so that you don't have to time the market. And I think that if you have a cash position on the side in case of large market drops, I think well, I don't know. I think you get into kind of like a dangerous game of then timing the market. I think even if you have a cash position, you'll start wondering and possibly overthinking when is going to be a good time to deploy that cash. When is the right time? Where is the bottom? And it's almost impossible to time that exactly perfectly. And so with that said, I do think it kind of defeats the purpose of dollar cost averaging, or basing your strategy around that. And if you just continue to dollar cost average, you'll catch the bottoms. You'll catch the bottoms along the way, and you'll catch things as they go back up. You'll catch things as they continue to go up. So it's just a much smoother ride. But once again, I do think once again, I think if you want to set some cash on the side and just for just for some ammunition when things do head south, I don't think there's anything wrong with that either. Um, and I definitely think it's possible to do both. I definitely think it's possible to dollar cost average and also take advantage of broad dips in the market or dips in the broad market when they do occur. So I guess that that doesn't really give you like a straight answer, but I don't really have one. I think there's a lot of gray area there. Okay, so could we take a look at Goldman Sachs? Yeah. What's the ticker symbol for Goldman? Is it GSBD? No, no, no. That's the BDC. What? What's the? Oh, GS. Okay. So, let's do this. And this one, I don't know, just based on how their financials are, this one might not be the best one to look at in here. Because its financials are set up more like a bank than like a normal company. And truth be told, Snapstock really does work best for like normal companies that aren't bank, aren't insurance companies, stuff like that. So the charting's probably not going to be the best. And like, the red flags and the snap scores probably won't be the most applicable because it is a little bit different. But the few things that we can look at are the revenue growth and the earnings per share growth. Both of them have been very solid. It looks like the earnings per share has not grown as fast as the revenue. And that's why we're seeing this decline in the margins here. So, and actually in the gross margins, there was a big dip as well too. So we're going to see a big debt position, but for a company like this, that may not be too crazy. Solid dividend growth. Yeah. Dividend looks to be pretty well covered by earnings. So, but like I said, it's not going to be the best for charting or for looking at the charts. I mean, but we can look at well, first of all, what's APH? We can definitely look at Fastenal. Oh, Amphenol. Yeah. Yeah. I feel like we've looked at this one somewhat recently. This one should work. Yeah. Looking good. Okay. So this one is tech. You guys with your fancy tech stocks. Okay. Really solid performance in the last year. Only one red flag. Snap score's looking great too. 8 out of 10. Very solid growth. Profitability down to capital efficiency look pretty solid as well. So the setup looks pretty good. Valuation stats, it looks to be a bit pricey, but based on this, it's going to be a pretty growthy company. So maybe it deserves a premium. With that said too, up 65%, basically at all-time highs. And with the dividend yield currently, 38% below the average, may not be the best time to buy it. But yeah, I mean, it's looking good. This is the tricky thing about buying what look to be high quality companies is, especially right now, it's like you find anything like this that just looks delicious and it's not going to be at a discount, except for AMAT. That one looked pretty good. And actually, there are a few other ones out there too. Let me just give you a quick sidebar that I have seen that kind of have stuff like this that I do think look pretty good. I talked about them in a recent video, but I think Verisk is one that's looking really good right now, VRSK. I think Old Dominion's looking great, although it did jump like 6% just today. What was it? There was a third one that I talked about. I think Watsco's looking interesting, although I am a little bit worried about the payout ratio on that one. But anyway, back to this. This looks really good. Okay. This is, yeah, really solid growth, nice margins. Margins look to be expanding slightly since 2019. So that's good. Debt is increasing, but it looks like the free cash flow is growing faster than the net debt. Because the net debt to free cash flow is going down. So even though the net debt is going up, the free cash flow is growing at a faster rate. So the debt looks to be increasingly serviceable. And this is where the one red flag is. So yeah, they've taken on a lot of debt over the last 10 years. That's no doubt about the debt. But, this red flag's kind of null and void, at least for now, because the free cash flow growth is so substantial. But it is something to keep an eye on, because if the free cash flow growth were to slow down, or if it were to decline, then this situation might not be as favorable. So it is something to keep an eye on. Yeah, low dividend yield, just another one of those guys. Low dividend yield, but a crazy dividend growth rate. So there is that. Dividend looks to be very well covered. Consistent returns on invested capital, about 15%. So yeah, I like it. I think this is looking pretty good. If I had to choose though, between this and Applied Materials, and I don't know exactly, like, I couldn't tell you the difference between what these businesses do, but just looking at these charts and even like the valuation, I think this is looking like a much better deal. No red flags, much higher snap score, although the last one wasn't bad. This one's actually looks to be priced much more attractively, higher starting yield, lower dividend growth rate, but, still very similar, I think, financial profiles. And this one is also generating considerably higher returns on invested capital. So if I had to make a comparison, I would probably lean towards this one, just based on what we're seeing here. So yeah, and this is a great question too from Taylor. Oh no, I'm sorry, Taylor, hold that thought. We'll come back to you. We also have to look at Fastenal. I really like Fastenal. We'll go through this one pretty quick because we've got about 10, 15 minutes left in the stream, guys. So Fastenal's seen a crazy gain, up 51% in the last year. One red flag, snap scores looking decent, perfect dividends, perfect debts, almost perfect debt. Yeah, some kind of mid scores there too. So one interesting thing to note too, real quick. So let's look at these valuation stats. The PE ratio is almost 40. Okay, pretty high PE ratio. Very low free cash flow yield of 1.5. So once again, comparing that to AMAT, the PE ratio was about half, and the free cash flow yield was about triple. And you were getting much better, a much higher growth score looking at the snap score. So, I would think with a PE ratio like this high, and a free cash flow yield this low, we're really paying a premium for it at current prices. And so naturally we'd want to see like just an exceptionally aggressively growing company. Based on the snap score, though, it doesn't look like that's so much the case. The growth is consistent. It's very, very, very consistent. It actually really doesn't skip a beat from top to bottom. It's pretty much growth every single year, but not nearly as fast or aggressive as Applied Materials. Totally different sectors, totally different companies, but I'm just looking at the charts and making the comparison based on that. So yeah, I don't know, but I do like this. I've always thought this was an interesting company. Just for this reason, it just, the charts look really good. Margins have been kind of declining. The gross margins have, at least, not too crazy. They've gone down 5% over the last decade, but still going down. But with that said, the net margins are steadily or slowly increasing. Looks like the free cash flow margins are kind of trickling up too. So it's not all bad. Net debt to free cash flow is looking really good. 0.24, which means that they have more free cash flow coming in per year than they have net debt on the balance sheet. So that's a great sign. So, and the dividend stats are okay. I mean, the 10-year growth rate's really solid on this, but the 5 years not nearly as impressive. So, and this is, what's up here? I would want to know what's going on here. Is this, huh? Oh, it's high all across the board. Wow. Is that true? The same case on Seeking Alpha? So Fastenal, really? That surprises me. Yeah? Okay. Hmm. Yeah, I don't like that. I don't like that. Okay, just for fun. So dividend per share is about, okay, 78, 70, 62. 78, 70, 62. 78. So it looks mostly covered by the free cash flow here. Okay, so maybe it's not as bad. Maybe there's just something throwing it off here on Snapstock. Mm. But either way, like even over here on Seeking Alpha, it's still, the payout ratio still looks very high. So that to me is concerning. But anyway, that's Fastenal. This next question from Taylor. Pretty new to this. Would you dollar cost average into stocks or ETFs, or do you wait for them to be on a discount? So when it comes to ETFs, I think it's a lot easier. I think with ETFs, yeah, you just dollar cost average into them. That's at least how I do it, without regard for, the price of them or the valuation of the ETF, which is a hard thing to value because it is just a basket of tons and tons of stocks, each with their own unique valuation. So, yeah, with ETFs, I would just dollar cost average into them, without question. That's the beauty of ETFs, and that's the beauty of like being an investor just in general in today's day and age. It's so easy to automate the process, and I think, yeah, with ETFs, just set aside a certain amount every week or every month, buy them, don't even think about it, just let them do their thing, and over a long period of time, you should be fine. That's kind of the whole game plan with those. But with individual companies, it's a bit different. I feel like that could be a can of worms, but yeah, when it comes to individual stocks, I'm not as big of a proponent as of just dollar cost averaging into them no matter what. I think you do have to be a little bit more mindful of the price and the valuation and what they've done, what the share price has done, the price action, excuse me, than you do with ETFs. And I actually think Fastenal is a good example of that. Like in the last year, it's up 51%. And yeah, I don't know. Excuse me. When it's already up so much and when the valuation metrics are so low, or when the valuation metrics are so unfavorable, I should say, you kind of have to compare the quality of the company with its current price and use that to try and gauge like the value that you'd be getting at its current price. And looking at this, there doesn't seem to be much value in it. Obviously, as opposed to when it was, $32 a share, it would have been a much better buy then, or even $35 per share. But yeah, I think it's tough to want to buy into individual companies after they've already run up so much. So, but then again, like on the other side of that, the argument against what I just said is, well, if they're high quality companies, then like over a long period of time, it should be like you should still be fine. Because the thing about high quality companies is that they tend to get better with time. And so if that's true, then you should be okay buying stocks like high quality stocks or high quality businesses, even if they are at all-time highs, because what seems like an all-time high today, it might end up being like a super low price down the road. And that's true too. I think you also have to think about your time horizon and how long you plan to be investing and how long you plan on owning these stocks. And I think if you have a long time horizon, whether it's 10 years, 15 years, 20 years, really the longer the time horizon, the more likely that you will, more likely that you'll make money on the investment. And so it's a bit easier to get away with like dollar cost averaging into stocks, I suppose. Like I said, it can be a can of worms going down that rabbit hole, but hopefully that helps bring a little bit of clarity, or at least helps you see both sides. So, and man, guys, I'm like 20 minutes behind in the chat. So we're gonna get caught up here. Scroll down a bit. Ooh, be still. Any new additions to the watch list? I don't think so. Let's go over here to my watch list, actually. See what we got cooking. So this is what it looks like right now. If might take a sec to load. Come on, don't fail me now. It'll load, I hope. Come on. Okay. Come on. Sorry, guys. There we go. Thank you. Okay. So this is what things are looking like right now. And I think the last two companies that I added to it were BMI, Badger Meter right here, and WD-40. I added these going into this month because I talked about them in last month's video, my 3 deeply discounted stocks. These were 2 of the 3. So these are my most recent additions. I did put Starbucks back on this list once I sold it from the portfolio. I did put it back on the watch list because I do want to keep an eye on it. And as far as these prices over here, you guys will see like my target price in the distance from target. Don't take that too seriously. They're just super rough numbers I put in just to put them on the watch list. But yeah, this is where everything's looking at right now. And I will say the ones that I'm probably most interested in right now, like I'm really interested in Old Dominion. I'm getting more interested in it, especially since it's pulled back some. I'd still like to see it cheaper though. Like it was as low as I think we can see it right here, 145. I still think my 135 price target is pretty fair. So I would like to see it around there. But if it got close, like I wouldn't make the same mistake with Rollins where I was like, nope, it's got to be below $30 per share or else I'm not buying it. I'm not going to do that again. You got to be a little bit, a little bit looser with it, especially like I was saying a few moments ago, if you're planning on holding these companies for a long time, you can afford to have some leniency. So Old Dominion's up there at the top. I was kind of thinking Verisk too recently. I just talked about that one again. But the more I think about this one, the more I think, nah, I'd rather just add more Visa. I think Badger Meter's pretty interesting. I'm not as interested in Pool Corporation as I was. Yeah, I think A.O. Smith is kind of I think all of these stocks are interesting, truth be told, but I really missed the boat on Wingstop. I talked about Wingstop, guys. Oh my goodness. I talked about it a few months ago, and it was right there at its 52-week low. It was like 220, maybe 230. I don't remember the exact price, but it has just run up a crazy amount since then. But yeah, that's pretty much it. Pretty much it over here. Still holding out for Rollins. Alas, though, it is $58 a share. I'm really, just a sidebar, I'm really stoked about this watch list, though. I think this is a really clean-looking watch list. I don't know what more I'd want to see here on this watch list. Okay, let's keep going. Andy, are there any stocks you regret selling? This is a good question. Truth be told, not really. I'm actually pretty happy with all of the sell decisions that I've made. Yeah, I mean, there's some though that are the share prices above like where I sold them at now. Um, 3M's one of those. I'm still glad that I sold out of 3M though. AT&T is another one, surprisingly. That one is quite a bit above where I sold it, but I still feel good about selling that one as well. So, okay, guys. I'm still about 20 minutes behind. I'm really going to scroll down because it's about time to wrap it up. Yeah, Brandon Watsco, I like it. I kind of talked about that one a little bit. I'm sorry, I'm just now seeing your comment. Yeah, it's funny that you bring up MAA too. I'm actually thinking of putting MAA in my 3 deeply discounted stocks video for September, which I'm going to be working on over the weekend. Um, and I think the price on that one's looking pretty good too. So yeah, I'll I won't get too into it because I am planning on talking about it. So, but yeah, I'll have that video coming out next week. Oh, Cracker Barrel. That's not a good one. We'll take a look at Cracker Barrel real quick, and we'll make this the last one, guys, and we're gonna wrap it up because it's dinner time. It is dinner time. And while I'm pulling this up, I see the Real Madrid question. What would it take for you to get back into Starbucks? Oops. Cracker CBRL. Right? Yeah. Yeah. So getting back into Starbucks, I would want to see, I'd really like to see them chip away at some of that debt. I'd really like to see the free cash flow payout ratio and the earnings payout ratio get back to a better place. And I would say that those are the two big things for me, but I'd also like to see comps going back up, everything going back up, revenue, earnings per share, and free cash flow. So the main thing for me with Starbucks was getting to be the dividend safety. So that's the biggest thing I'd like to see changed. Now, getting into Cracker Barrel, it's not looking good at all. There's really doesn't seem to be any redeeming qualities for this one. Yeah, and the price to free cash flow sitting at about 50, but the only reason this is so high is because the free cash flow, I'm sure, has really taken a hit. So yeah, sales have been still growing. That's actually pretty good looking sales growth, pretty consistent, but everything else is just terrible. Not good. Yeah, not good at all. Oh my goodness gracious. Yeah, it's bad. It's really bad. Wow, poor Cracker Barrel. Cracker Barrel was my grandpa's one of his favorite restaurants. Anytime we'd go on a road trip, he'd always map out where the Cracker Barrels are. Actually, he wouldn't even map them out. He'd always just know. He'd just sniff them out. So every time I see Cracker Barrel or anything related to Cracker Barrel, I always think of my grandpa. Okay, guys. So I think this is a pretty good place to wrap it up. Fun stream tonight. We looked at some good companies. I am stoked to have seen Comfort Systems and Applied Materials. I need to look for one more stock whose dividend growth rate is actually increasing over the years. So last thing before I let you guys go, if you have any suggestions for me for that third stock, share them in the chat because I think this would be a good video to make. 3 dividend growth rockets or something like that. I made a video like that maybe a year or so ago, and it's fun to find these. Really, BTI. Let's look. Or Philip Morris. Not really. I mean, looking at this, yeah, not really. Philip Morris. Okay, Cheesecake Factory, really? Yeah, Philip Morris, their dividend growth is slowing down. Cake. No, not really. I don't know. I'll find a third one. I think Zoetis was one, if I remember correctly. Yeah, it was. It was, but not these last couple of years. MCK, McCormick? Oh, McKesson? MKC, I think, is McCormick. Um, yeah, kinda. Yeah, Broadcom. Of course. Of course. Probably, though. No, actually, Broadcom's dividend growth is slowing down. It's really slowing down. MSCI, that could be one. That could definitely be one. Look at that. Really nice snap score. Yeah, this is looking good. No, they're slowing down too. Yeah, see, it's tough. It's tough to find these ones that ASML probably. ASML, I think, has the highest snap score that I've seen on here. 9.56, yeah. Oh man. No. But the thing I could be wrong. I'm wondering if they pay special dividends. I'm wondering. Or maybe because they're a European company, their dividend is not as their dividend policy is not as consistent as here in the States. That's why we're seeing this on the chart. No, I don't think Microsoft or Visa. I mean, their dividend growth is definitely steady, but I don't think it's increasing. Yeah, Visa. Yeah, Novo Nordisk could be one too, but we'll see. Like, let's see. Yeah, there you go. Good job. Okay, we've got our third dividend rocket. So we have Comfort Systems, Applied Materials, and Novo Nordisk. I know a lot of you guys out there are liking Novo right now too. Yeah, that's nice. Look at that. With that though, in this is kind of, well, no, it's not that interesting. I was going to say the payout ratio is super high, but no. Big jump, but no, it's not super high. Interestingly, the earnings payout ratio is actually going down as they're speeding up the dividend growth rate. Actually, the free cash flow payout ratio historically is going down too, except for these last couple of years. So there we go. Good job. TJX, TJ Maxx could be. It definitely could be. Here we go, guys. Can of worms. No. Doesn't look like it. ETR? Entergy? I vaguely remember this one. We definitely looked at this one. Yeah, actually, this one does look to be picking up. Kinda. It was. Yeah, kinda. I mean, I'd say that the general trend is up and to the right. Yeah, that's kind of one. Genworth? I've not heard of this one. No. No. Anyway, guys, we got our three solid choices for sure. Texas Roadhouse might be one, actually. Sorry. Texas Roadhouse might be, no, it's not. It's slowing down. Okay, that's enough of that. Yeah, so we are definitely wrapping it up, guys. Thank you so much for hanging out with me, though. This was fun. Fun way to end it, too. Once again, I always appreciate your guys' support here on the live stream. So happy that you guys choose to come back and spend a little bit of your Friday nights with me. Something I look forward to every single week. Last question. Okay, I promise last question because I really need to go. Told my wife I was going to finish early. I'm in trouble, guys. I'm in trouble. Okay. Last question. What do you think we're going to open with Monday? Are we going to be up in the green or are we going to see some red in the market? What do you think? Closing question. Monday predictions. Okay. Pretty mixed bag. See a little more green than red. Yeah, man says red. Chris says green on Monday, but red on Tuesday. Okay. Yeah. Yeah. I would not be surprised if we opened with some red. I don't know though. You never know. Obviously, it's a coin toss for sure. So anyway, guys, we're ending it for real. Thank you so much for hanging out with me. I hope you all have a great weekend, and I will see you in the next one.